learn about the international portfolio investment and international asset pricing. So let's have a brief introduction about the international portfolio investment. In other words, we can also call the international portfolio global portfolio or the foreign portfolio investment. So in one word we have we can pronounce a different names but have a same meaning. So let's have a brief introduction. The first one is introduction portfolio investment. It is also called a global, it is also called a foreign as well. So it refers to all those investments which are made by an individuals or an organization from one country into any financial assets like stock, bond, or any of the mutual funds of another country. It becomes a foreign portfolio investment. For in respect of the type of the portfolio investment which called a foreign direct investment, which is different from this particular concept where the investors seeks a significant influence or control over the company. That's called the foreign direct investment. But foreign you can see or international portfolio investment is more passive. It doesn't have more control over the company. Investors have autonomy to do an investment into any of the financial assets of any other country according to their fit towards earning a higher returns. The goal of this particular concept is to generate the maximum returns through appreciation in the currency's rate or any of the interest in charge on any of the financial asset, we called an higher interest without active participation of the investment. Next, we talk about the key aspects of the foreign portfolio investment or international portfolio investment. The first one is liquidity. So the foreign portfolio investments are relatively liquid. It could be easily purchased or sold in the public markets like called stock exchanges. Next one is the short-term focus. So foreign portfolio investments tend to be more short-term in nature as compared to foreign direct investment because they are more FDI is more control over the company, but FPI are more passive, which makes the investors free to take their own financial decisions while investing in the financial assets of another company. So here the investors are more quicker to move funds in and out of the country, so they can take a quick decisions regarding the funds to take in and out of a country based on the market situations, any of the interest rates or political you can say events, etc. Next one is the risk exposure. So the foreign portfolio investment is all about the market risk, any of the currency fluctuation or the geopolitical risk. So where the investor must aware and must have a knowledge about all these risks while investing into any of the assets in another country. Next one is economic impact. So foreign portfolio investments can lead to a capital inflows that may boost a country's stock market and financial system. So after all, what the foreign portfolio investment leads, it's all about the inflow, the fund inflow, which automatically improves the country's stock market and financial system, and ultimately it refers to a rapid outflow during times of instability and of course stimulate the economic volatility. Next one is the tax and the regulatory considerations. So when we talk about the tax policies, every countries have different tax policies and accordingly they apply to country to country. So the countries may have a specific tax policies or the treaties or regulation when definitely apply to a foreign portfolio investment so that they can attract and control the foreign investment. And that's what every country do, where the and just implement the tax policy just to control any situation or circumstances which ultimately impact the country's stock market or financial system. Next one is, these are the recent foreign portfolio investment examples in India. So according to the SEBI report in March 2024, it reveals that the distribution of the foreign portfolio investment across the various countries, with the United States leading with 3,457 registered foreign portfolio investment, followed by its Luxembourg with 1,393 and Canada with 804. Foreign portfolio investment have demonstrated a growing interest in the Indian debt market. It's emerging the net buyers for the second consecutive year, with the cash inflows of United States in dollars around 13.10 billion. That means rupees 1.1 lakh crores in 2004. Under the foreign you can say portfolio investments, the investors have invested more than rupees 87,000 crores, over $10 billion, into a domestic equity this quarter, and making the highest inflow since the September quarter ending in June 2023. And hence, after viewing all these figures where the investors invested in the Indian debt market and show a growing interest into the equity or debt market, where the buyers are more you can say listed and become a second consequent years with their inflows in dollars, and hence it is likely to say that India will soon be a preferred destination for portfolio investors if the current trends continue. So the more and more Indian investors involved in it, then definitely India will become a preferred destination soon. Next is the benefits of international portfolio investment. So the first one is the benefits to the host country, where the investors invest in the financial assets of the another country. So in the companies who are operate in outside India or in abroad, that becomes the host country. So what are the benefits to that country? So once the investor invests into the other countries' financial products. So the first one is the increased capital inflow. So the foreign portfolio investment brings then additional capital into the host country. So as the investment as the investment grows, the inflows will always bring as an additional capital in that country, which can be used for the economic progress or you can say development projects, or of course to overcome the current account deficit. Next one is enhanced market liquidity. So with an increased participation in financial market, the foreign portfolio investment improves the liquidity, which makes it easier for all those companies who are mainly into to raise the capital, and for investors, they can trade in the securities. That means the financial securities like stock, bonds, etc. Next one is the lower cost of capital. So the higher the supply of capital in the markets, and definitely it would reduce the cost of borrowing for the domestic companies and the government promoting investments. So in this way, the investment opportunities are being promoted among the investors if the higher supply of capital in the market will definitely, if it reduce the cost of borrowing for the domestic companies, then of course it refers to or leads to promote investment opportunities. Next one is to access to global expertise. So as the more and more investors in making an investment in the financial assets of another country into a business who operates and constructed outside the India, so definitely it encourages the knowledge transfer, adoption of the international best practices in financial markets or corporate governance. So it always enhance the overall efficiency and the transparency of the local markets. Next one is it boosts the stock market and asset prices. So inflow of the foreign capital, it leads to a higher stock prices and assets valuation, which always creates a wealth for the local investors and of course for the further economic activity. So this is how the inflow of the foreign capital leads to a more inflow into the stock market, and of course it always begin a process to evaluate more and more about the financial assets, which ultimately leads to create and wealth for local investors in that host country. Next is currency stability. So the foreign investors convert their capital into the local currencies as well, so that they also you can say build up the domestic currency and stabilize the exchange rates. Next one is economic growth. The inflow of funds from which has been come from the foreign portfolio investment, they also stimulate the investment in the productive sectors like education, hospitalization, hospitality sector, and ultimately it contributes to the higher GDP growth. Now the next one is benefits to the investors. What are the benefits if they invest you can say in financial assets in another country? So the first one is diversification. So the foreign portfolio investment or the international portfolio investment allows investors to diversify their portfolio by gaining you can say international exposure or gaining exposure in international markets. So it reduces the risk which is associated with their investment in one country or any region. Next one is higher. They are also getting benefit of earning or gaining higher returns. If investors seeks more and more opportunities in the foreign markets and ultimately offers an higher returns than their home market, then definitely it is an emerging market you can say with higher growth rates. Next one is currency gain. Foreign portfolio investment is also enables the investors to potentially benefit from the favorable currency fluctuation. So if there is a favorable currency fluctuation goes on in the country or between the countries, the investors will also get the advantage of such fluctuation, and of course it also gain from asset appreciation. Of course, if the asset the value of the asset will also get appreciated, or you can say in this way they will gain in the currencies exchange from, or you can say one to another country. Next one is flexibility. So the foreign direct investment, so it is when we talk about the foreign direct investment, which could be a similar concept in case of flexibility, where the foreign portfolio investment provides the investors with the flexibility to quickly you can say enter or exit the markets, which leads to a more liquidity and responsive investment strategies. Next one is access to emerging market. Foreign you can say foreign portfolio investment provides an access to fast growing economies where the local investors are also may face a lack of resources or infrastructures in the capital market. Next one is global economic exposure. So the investors of course gain an exposure for the broader range of industries. So if in the domestic you can see country where the investor doesn't get more and more investment opportunities in the broader range of industries, but while going up internationally, investor gain an exposure of a you can say broad range of industries, and of course they will gain a different market trends, market cycle, which may not be present in their domestic economy or country. Now we can come up to the next important concept, that what are the factors which affect the global portfolio investment. So the first, or the international portfolio investment, the first one is tax rates. Tax rates on dividends or interest earned is a major influence factor which affect the global portfolio investment, because as the investors usually choose to invest in a country where the applied taxes on the interest on or dividend you can say acquired is low. So after all, when investors invest into a financial assets of another country, they actually expecting or expected that the applied taxes or any of the interest or dividend acquired should be low. So investors normally calculate, they will gain a knowledge to calculate the potential after tax earning they will secure from the investment in the foreign securities, which they have made up in such foreign securities. Next is interest rate. Higher interest rates are always be a big attraction for investors. And this way the money usually flow from one country to another country, and which have a higher interest rates. So the higher interest rates definitely which also influence the major attraction for the investors. And the local currencies must, in fact, local currency must not weaken for the long period as well. So the local currency may not also affected due to the higher interest rate as well for a long period too. So this is also the one of the major factor which influence the GPI. And the last one is exchange rates. So when the investors invest in securities in an international countries, their return is mostly affected by two main factors: the change in the value of a security and the fluctuation in the value of currency. So in this way, while gaining a knowledge of the fluctuations in the exchange rates, investor immediately shift their investment when the value of currency of a nation fluctuate or may get weaker more than the expected or anticipated, and in this way the investor take a quick decision about their investment choices. Next one is drawbacks of the global portfolio management. The first one is the unfavorable exchange rate movement. So investors are of course unable to ignore the probability of the exchange rate changes in the foreign currency. It may not get enough exposure about the exchange rate fluctuations, and of course, if not possible, ultimately it influences the total value of the foreign portfolio and their earnings from the investment. Next one is the frictions in international financial market. So there may be a various kinds of market frictions or the changes in the foreign country or economy, and these frictions definitely you can say comes to a government's you can say expects. It could be a government, more and more government control, changes in the tax laws, or explicit or the implicit transaction costs. Next one is manipulation of security prices. Government and of course the powerful brokers may also influence the security prices, and government which always impose a control over the prices by modifying their monetary and the fiscal policies, which is something a major drawback of such portfolio investments. And hence the public sector institution and banks, of course, they will take a higher share of the securities which are being traded on the stock exchange by the investors. So this is something, a manipulation of the security prices, where the brokers and the government could also influence such security prices, which ultimately does harm for the investors. Next one is the unequal access to information. So wide cross-cultural differences may be a barrier to the global portfolio management or investment. So it is very difficult in this scenario to disseminate, to circulate the necessary information by the international investors beforehand. So it is very difficult for them as well, that before making an investment they don't easily get the useful or the necessary information about the international security. And if information is tough to obtain, it is very difficult to take the decision rationally and in a prudent manner. Next important concept is international bond market. So the international bond market is actually called a global bond market as well, or the foreign bond market as well. So it is a global marketplace where the government, municipalities, corporation, they raise funds by issuing the debt security we call bonds to investors in countries other than their own. So that's become the international bond market, where the investors are more engaged to you can say buy the debt securities in other countries. And of course, when we talk about the government, the business organizations or the foreign companies who raise funds to offer such securities like bonds to investors in foreign country, it becomes the international bond market. So investors purchase these bonds effectively, then they just lend money to the issuer, receive the periodic interest payments and the return of their principal upon the bond matures or reaches to its due date. So the international bond market involves the issuance and the trading of bonds to by entities in foreign countries. So it's a very basic concept where such enterprises or organization offers raise funds by issuing such debt securities to investors in other countries, so that they just provide capital for the issuers and open up a new investment opportunities for them to diversify the bundle of investments into other types of bond or debt securities. Types of international bonds. The first one is the foreign bonds. So in foreign bonds, the issuer is from one country, but he issue the bonds in some other country. It becomes the foreign bonds. So the issuer issues these bonds in the local currency of the country where he is issuing bonds. So if I'm in the foreign country and I'm issuing the bonds, so I'm issuing, let's say I'm in the US and issuing in the you can say bonds in the US dollar only. So it becomes the foreign bonds. For example, of a foreign bond will be a US company and issuing bonds to raise capital in India. So the US company will issue the bonds in Indian rupee. As the result, Indian investors will not be to take care of up and downs of the foreign exchange market, because it is an American company come up to India and issuing bonds. So Indian investor does not care about or does not aware about the foreign exchange market. So they will invest in Indian rupees and earn interest in Indian rupees. So an Indian company you can say or can also issue bonds in India in their Indian rupees as well. And when we talk about when Indian company issue bonds in Indian market in Indian rupees, it becomes a domestic bond. But if such Indian company operates you can say in another country and issuing the Indian bonds into a foreign country and in US dollar, it becomes a foreign bonds. So such bond if classify foreign bonds when it comes to the foreign issuer. So if any of the international company you can say come to any of the country and just issuing the bonds in their own country currency, it becomes the foreign bond. So this is how this cycle goes on, and investors earn a higher interest rate in it. Next one is the Euro bond. In Euro bond, a foreign organization issue a bond in the domestic market. The issuer issue a bond in a currency that is not in the domestic currency of that country. So a Euro bond in the US country can be issued in any country other than the US. So it is all about the bond which is issue a bond in the domestic market, and accordingly the process would goes on. So let's take an example to understand. If the US company issue bonds in Japan in pound, in UK pound sterling, it will also an example of Euro bond, because Euro bond is a result of unfavorable tax policies of the 1960s in the US, and accordingly the US company issue bonds in the US dollar outside the USA only. So if any of the US company issue the bond in the dollar only outside the country as well, it becomes a Euro bond. And investors definitely they have to take care of about the up and down of the foreign exchange market. So if we come to the previous type, that is foreign bonds, the Indian investor doesn't care or talk about the up and down of the foreign exchange market. But in this market where the one company of the country and issue the bonds in their own currency to another country, it becomes a Euro bond. Then investors have to take care about what would be the up and down turns of the foreign exchange rates. Next one is key features of euro bonds. International capital access. Issuers gain, so the organizations who raise funds or issue bonds in the domestic currency only. So if the US company issue bonds in their domestic country to the another issue another you can say investors of another country, so definitely the international capital access would be broader outside their domestic market. Foreign currency denomination, so the bonds are issued in a currency other than the issuer home country currency, that becomes a currency fluctuation, that actually leads to a currency flexibility. Next one is potentially lower borrowing cost. So the issuers can of course secure the lower interest rates compared to the domestic borrowings with a strong credit rating. So if your credit score, if any of the issuers have a higher or a strong credit score, then definitely they can also secure the lower interest rate compared to their domestic borrowings rates. Next one is reduced regulatory security. So euro bonds of course face a less regulation, tax laws than the domestic bonds. Bearer securities, they are usually bearer securities where the bond holder is an owner, not the issuer. So when the issuer issue bonds to the you can say to the owner, it becomes a bond holder. Long maturity periods. Euro bonds typically have a long maturities of ranging from 5 to 30 years. Fixed and floating interest rates. They can offer a fixed or floating you can say coupon interest rates with payments usually made annually or the semi-annually. Last one is the underwritten by syndicates. International syndicates of the financial institutions underwrite the issuance of these bonds. Okay, these are the underwriters who have an authority to issue the bonds to the investors in the another country. So this is how the undertaking for undertaking is to be important or significant, you can say, for the issuers and you can say along with the investors. Let's talk about what are the secondary market for the euro bonds. So over the counter trading. So over the counter trading is one of the secondary market for such bonds. So the according exchange traded securities, euro bonds are traded directly between the parties in an over the counter market, that immediately they can go to the counter in the market over the counter where the screen the prices list has been shown, and accordingly they can trade. So this is how the euro bonds can also be involved to immediately sell within a point of time. Major financial centers, significant trading is also being done for the secondary market like London, Frankfurt, Zurich and Amsterdam. Next one is settlement systems. So the clearing or the settlement system of such bonds are facilitated by the settlement systems like Euroclear or the Clearstream. So these are the settlement systems where the transaction has to be settled down and the payments has been received into their account, and accordingly the settlement system will always work for the investors to just finish the transaction at the earliest. Next one is liquidity. Liquidity of the euro bonds tends to be a higher when denominated in a strong foreign currencies and of course issue in a strong economy. So as the euro bonds are more liquid, so definitely the you can say the liquidity rate would be more higher in such bonds, and of course it's just because of the strong foreign currencies and issued in a strong economy. Let's say if we talk about the US, the euro bonds are more liquidable because of their strong currency rate and of course the strong economy. So this is how the euro bond works in the secondary market based on these factors. Next one is price determinants. The selling price of a euro bonds before maturity is based on the market conditions. So it's all about whenever any of the bond price is to be determined, is totally depends upon the market forces about the keeping in view the market conditions. So the selling price of the euro bond before maturity is based on the market condition at the time of sale. Next one is disbursement of funds. So after the issuing of such bonds, a paying agent collects the principal and interest from the borrower and distribute it to the investor. So it's a cycling process or the continuous process. When the bond is issued, then the agent would begin their work to collect the principal amount or interest amount from the borrower and such then distribute to the investors. So this is how a cyclical process which goes on under the euro market. And the next type of bond, international bond. It becomes the second one is global bonds. So apart from the foreign bonds or the euro bonds, some companies rarely issue global bonds. So there are very less companies who are issuing such bonds, and it's a very rare cases where the companies issue the global bonds. So in global bonds, bonds are issued in multiple currencies at a you can say one time, and often in multiple currencies. So large multinational corporations only issue a global bonds. So this is a one of the type which is a rare case where the largest corporations issue such bonds in multiple countries also, and of course in multiple currencies, and that becomes a global bond. Next is foreign and global bond risks. What are the risks involved in the bonds? The first one is the interest rate risk. Foreign bonds are very sensitive when there is a changes in the interest rates, and when interest rate rises, the market value of such bond it's decrease, and it never bonds offer the higher returns. Let's take an example. If the investor hold a 10-year bond with a 4% yield value and foreign bond rate rise to 5%, then the bond resale value will decline. And when such rate, yield rate, the return rate, and the foreign bond rates have fluctuation or faces fluctuations in it, then definitely the resale value of such bond would also get declined. So in such a way, the market would becomes a more you can say volatile, where the interest rate fluctuation definitely impact the bond prices. Next one is inflation risk. Inflation is also the one of the factor which impact the fixed income investments. So if the investors purchases a bond with a 5% interest rate and inflation rate rises to 3% or 2 to 3%, the real return drops to just 2%. So that means if the investor purchases a bond at 5% interest and inflation rises to 3%, the difference, that means the returns from that investment is also reduced to 2%, a difference of 5 and 3%, so drop by 2%. So in countries with a high or unpredictable inflation, this risk then definitely decline the purchasing power of the bond returns and making the foreign bonds less attractive. Next one is the currency risk. Currency fluctuation is also impact the returns of the foreign bonds. Let's take an example. A bond yields 7% in a foreign currency might only yield 2% when converted back to the investor home currency. So if in the US the bond yield rate is 7%, and when it convert back to the Indian currencies in India, it yield 2%. That is unfavorable, and it is just due to the unfavorable exchange rate movements or fluctuation, and this is called currency risk. So the currency risk in foreign bond investment is inherent because it could change any time, any you can say any second or minute in it. So it inherent in all the foreign bonds investment and leads to an unexpected losses. Next one is political risk. Bond repayments may also be threatened just due to the political unrest in the you can say issuing nation. So if it is in US and any of the political events come up in a way when it comes to a repayments of the bonds, it's just a threatened given to the investors, foreign investors. So the economic penalties, civil instability, and the changes in the government policy could also result in defaults or delay in interest payments. Let's take an example. Investor risk losing principal or interest payments if the nation experiencing political instability, and of course it also challenging to fulfill the debt commitments as well. Next one is credit risk. Foreign bonds carry the risk of default by the issuer, especially in the emerging markets with markets financial system with a weak financial system. Even if a bond has a higher credit rating, systematic risk or the economic downturns in the issuing country may also impact the likelihood of default, and their chances of defaulters rates or would get increasing. Would get increased. Investors must assess the issuer credit worthiness and monitor the economic condition to mitigate this risk. So this is something which is very important for the investors and the issuer company to evaluate the credit worthiness of the issuer and then accordingly issue the bonds to them. And of course it is also important to consider the risk and economic systematic risk in terms of issuing credit or economic downturns as well. So it is very important for the issuing company to consider these factors before issuing and mitigate this risk. Next market is the international equity market. International equity market is a global network of exchanges where the stock shares of companies from different countries would come together. They issue and trade and providing investors access to enter into a diversified range of companies with their products worldwide, and that's become an international equity market which not deals with shares, they also deals with stock and shares or any other financial assets as well, where they are not come to they are not just to invest to a specific one country company. It refer it they such investors can also trade into a diversified range of companies worldwide, and these markets serve a crucial platforms for the global finance, and it also strengthened the every country economy, and of course and raise the capital from the international investors, and in this way it also allow investors to diversify their portfolios beyond their domestic markets. Let's take an example to understand this market, this type of market. An investor in India can buy shares of Apple, a US based company, on the New York Stock Exchange. An American equity market through international you can say trading platforms or the mutual funds that invest globally. This is how an Indian investors buy shares of Apple and on a New York Stock Exchange, which is an American equity market, and in this way the international trading process you can see goes on for the investment purposes globally. Reasons for international investments. One of the reason is diversification. It's totally spread over the investment across different markets, which helps to reduce the portfolio risk like currency risk, interest risk, political risk. In this way, when the investors diversify their portfolios into a different companies in different companies of different countries worldwide, then definitely the investors are more engaged to work or to invest towards the international securities or financial securities of another country. Next one is exposure to high growth markets. Emerging markets provides an opportunity to receive or to gain the higher returns. Currency and economic advantages. Foreign currency and economic, it always have the potential to favor and affect the investment nations. Next one is it reduced the reliance on the US economic performances. So investing internationally helps the investor to get a potential benefit from their investment, and in this way the economic growth would get built up in other regions even if the US economy is underperforming. Now the next important concept is difference between the American depository receipt and the global depository receipt. The main difference in their trading market or the target investor are for the US investors who trade on the US stock exchanges, while global depository receipts are the global investors who belong to a different countries and they just trade on non-US international exchanges, and this is a main difference between these two. American, which deals with the American trade exchanges, and global, it deals with the non-US international exchanges. GDR offers a greater flexibility by allowing companies to raise capital in multiple international markets and are denominated in the various currencies like US dollar and the euro. Now we talk about the key differences between these two major concepts. The first one is the issuing market. ADR are mainly issued in the US market and the GDR are issued globally. Trading currency, ADR traded in US dollar and GDR trading in any foreign currency. It could be rupees, it could be euro, it could be pound, sterling, etc. Next is investors. ADR primarily attract US investors, but GDR attract investors worldwide. Listing. ADR can be listed on any US stock exchange and GDR listed on European stock exchanges. Regulation. ADR is the regulation imposed by the US Security and Exchange Commission, and GDR are regulated by the securities market regulator of the issuing country. Sponsorship. ADR requires sponsorship from the US based bank, but GDR need a sponsoring bank based on the country of listing. Dividends. Dividend on ADR are paid in US dollar and GDR paid dividend in the currencies of the country where they are issued. If it is India, the commission or the dividend will be paid in Indian rupees. Purpose. ADR are typically used by foreign companies to raise capital in the US, while GDR are employed by companies to raise capital globally. Issuing company country of origin. Companies issuing ADR, that is American Depository Receipt, are typically based outside the US, while the companies issuing GDR can be based anywhere including the US. Taxation. Taxation on ADR and GDR differ according to the regulation of the respective issuing country. If India is issuing GDR, or the various or the Indian institution or Indian financial institutions issue GDR, then the regulation is according to regulations, rules or regulation or taxation framework will be worked on of a respective issuing country, that is India. Now we come up to the next main section or important section, that is how to measure exchange risks on foreign securities. So to measure exchange risk on foreign securities, investors can use any of the statistical methods like standard deviation to quantify the currency volatility, and the more advanced techniques like value at risk VAR, which estimates the potential losses over the given time with the specific confidence level, which could be 5% or 10%, using historical variance covariance methods of costing or Monte Carlo models. It is a mathematical model which will be used to measure exchange rate on foreign securities. Another approach involves is a regression model to measure asset sensitivity in order to exchange if there is any exchange rate changes. Investors should also consider the investment currency exposure. It is very important for the investors to gain a knowledge about the currencies, investment currencies exposure, like direct investment in foreign denominated securities, to understand their specific risk level. So this is a regression model to use or to measure the exchange risk. So investors can use the regression analysis to measure how much the domestic value of the foreign security changes due to a fluctuation in the exchange rate, and the formula stands for AV is equal to beta M, that is beta T ASU, where delta V, that is the change in the domestic value of the security. Instead of A, V, it's called a delta A, delta V, which refers to a change in the domestic value of the security. Delta SU is a change in the exchange rate, and the beta is a slope coefficient. It represents the security sensitivity, how much the rate would be there which occurs a changes in the foreign security, or in other words it gives an exposure to the investors about the exchange rate, and that's called the beta. That's in other words called a slope coefficient, which denotes a security sensitive to assess the security sensitivity and exposure level of the exchange rate. So delta V is equal to the beta O, that is beta I delta SU. So this is the exact equation of the regression model where the investors can use and measure the exchange risk of a foreign securities. Next concept is international portfolio diversification. Portfolio diversification is investment strategies which always gives a knowledge to the investors that how they can spread their investment capital across the various ranges of assets or securities within your own investment portfolio. So the aim of diversification is to reduce risk, increase the likelihood of achieving more stable and consistent returns over a period of time. The main principle of such concept is based on the idea that different assets from various level of risk, and you can say different assets definitely having a various level of risk and return potential, but it is very important for the investor to gain that how to hold a mix of assets with low or negatively correlated price movements. So the positive performance of some assets, they might help you can say to the investors, which offset the negative performance of others during market fluctuation. It happens when there is a situation of the market fluctuation that one investors which definitely received gain a positive performance, but at the same time they gain a negative performance, but this strategy will immediately offset the economic negative performance into the positive performance, even if there is a fluctuations in the market trends. Key aspect of portfolio diversification: asset allocation. So it's dividing your investment among different asset classes like stock, bonds, real estate, commodities, or any other cash equivalents. Next one is a geographic diversification. So investing in assets from different countries or region can further reduce risk like economic condition, tax regulation, market trends. They definitely vary around the it's always differs worldwide or can vary around the globe. Next is industry and sector diversification. So within the stock market, diversifying across various industries and sector can also minimize the exposure risk to a specific business, or economic risk may disappropriate and affect the one industry. Next one is individual security diversification. So if the investor invests in individual stock or bonds, or spreading your investment across a wide range of companies or the issuers, can reduce the impact of adverse effect which affecting a single country or economy. Time diversification: investing over you can say an extended period instead of putting all the money in the market at once can also mitigate the impact of the short-term market fluctuations. Next is the benefits of portfolio diversification. It always reduces the risk, because diversification is all about to invest in a broad range of industries of different countries, and in this way the investor could reduce their investment risks. Next one is consistent returns. Diversification is more about to receive a stable and consistent returns over the period of time. So with some investments may experience fluctuation or downturns, but the other may perform well or balancing the overall portfolio performances. Improved risk adjusted returns as well. So diversified portfolio may also achieve the better risk adjusted returns. Even a particular investment portfolio may receive a higher returns for a given level of risk compared to the non-diversified portfolio. Next is exposure to various opportunities. So this diversification, the concept of diversification, which also expose the investors to gain a knowledge about the various new investment opportunities in different assets. And the last one is protection against volatility. So in times of market you can say disturbance or economic uncertainty, this concept is always allow the investor to take care of your portfolio, providing you can say a platform over to distribute or to make an investment in different assets or less risky investments opportunities, rather than the more risky, which ultimately decline the value of the foreign securities. That's it for today. Thank you so much for listening this lecture. I will come up to a more and more interesting and important topics in the upcoming sessions. Till time, thank you and namaste to all.